Today we're going to talk about one of the fundamental principles of strategy, cash rules. So in this course, we talk a lot about how important it is that a company creates economic value, captures economic value, and sustains it over time. But how do you know if you've created and captured economic value? Well, the best single answer is as a company, you're generating positive cash flows after the investments required to keep your business running. Okay, so the way a company is valued is by taking its cash flows, its current cash flows, forecasting those into the future, and then discounting those back into their present value, adjusting for cost of capital and adjusting for risk. So at its heart, the value of a company, how well it's done in creating and capturing economic value, is measured in terms of cash flow. And what's interesting about this is the most sophisticated, high-octane finance professors will tell you cash flow drives valuation. The most dirt under their fingernail, practical private equity practitioners will tell you cash is what drives valuation. Cash flow is at the heart of knowing whether a company has created and captured economic value. In other words, cash rules. Cash is not king. Cash is not queen. It is those things, but not only those things. Cash is the entire royal family. So in this course, because this class happens first semester or first year and you won't have taken, or you'll be taking accounting concurrently, and many of you won't have taken finance yet, we're going to calculate a simplified version of free cash flow. And we're going to calculate it as follows. We're going to start with earnings before interest and tax. And what's nice about that line on the income statement is that we've deducted the costs required to run the business, right? So your cost of goods sold, obviously, but also sales, general, administrative, marketing, R&D, all of those have been deducted. And that's appropriate because you need to spend that money in order to generate the cash. Then we add back depreciation and amortization. And you'll talk more about this in your accounting class, but the basic idea is these are charges that appear on your income statement, but there's no cash out of pocket. You've already paid that cash in the past, and now you're just charging a chunk of it every year, but no cash is coming out of your pocket for depreciation and amortization. So we're going to add that back to our earnings before interest and tax. When we add those together, what we get is EBITDA. So that's earnings before interest and tax, depreciation, and amortization. And a lot of times people will use, in private equity, for instance, people will use EBITDA as a good enough first approximation of free cash flow. When they're calculating interest coverages or valuing a business, they'll often take a multiple of EBITDA. We're going to do a little better than that. What we're going to do is deduct capital expenditures. So if you're a company like Tesla, for instance, and you've got to build factories and you've got to invest in these robots, that's real cash out of pocket that you have to spend in order to generate the cash from selling the cars. So we should take that into account. We do take that into account. We'll also take into account change in working capital. So say you're, again, Tesla, and you're building a big inventory of cars, and you haven't sold those cars yet, and they're stored in a warehouse somewhere. Well, that's real cash out of pocket. The raw materials, the labor you paid to develop those cars that you haven't sold yet, that buildup in inventory is pulling cash out of your pocket. So we're going to take that into account. Now, ultimately, of course, when you sell those cars, you're going to get some cash. So it's a timing issue. But for this period, that buildup in inventory is deducting cash. It's less cash that you have available. And similarly for accounts receivable and accounts payable and so forth. So we're going to look at the change in working capital in a period to see how much cash it's either absorbed or generated. And by the way, change in working capital can actually be positive. You may be generating cash flow by drawing down your inventories or stretching out your payables or collecting your receivables more quickly. And when we add all of these together, what we're going to get is our simplified free cash flow. And again, for our purposes in this course, that's going to be largely good enough to help us to gain insight on the fundamental question of, has this company done a good job of creating and capturing economic value? We're going to ignore, for now, a few things. We're going to ignore taxes because, again, we want to focus in on how well is this company doing in its as an operational entity in terms of its strategy and execution of that strategy, not how it's influenced by its tax policy. We'll ignore other non-cash charges besides depreciation and amortization, some of which can be consequential, and you'll learn to incorporate those in your cash flow analysis. We'll ignore acquisitions, and that's important because a company can, a company like Tesla can build capacity through capital expenditure. It can also buy capacity, as it did with its first plant in Fremont, through acquisitions. And really, you need to account for both of those. And if you do that in your analysis, that would be terrific. And we're going to ignore the structure of the balance sheet, and in particular, how the amount of debt that a company has taken on would influence interest, which is an actual out-of-pocket charge, and also payment of debt. So we're ignoring those things now, and that's why we're calling it a simplified free cash flow. It's an unlevered, ignoring tax free cash flow to hone in on the operations. Now, some of you may feel a little discomfort at this point. This is a lot to take in, especially for a concept as central as calculating cash flows, which really answer the question of whether a company has created and captured economic value. But I encourage you not to worry. So there are a couple ways you can learn more, both in this course and beyond. So the Strategy Analytics Memo, section 2-3, talks about how to calculate free cash flow and walks through some examples. The Tesla Data Supplement walks through, in the Tesla case, on a quarterly basis, calculation of cash flows. Your accounting classes, you'll dig into the elements of free cash flow and things like non-cash charges beyond depreciation and amortization, how to think about capital expenditure versus acquisition of capacity, all important issues you'll cover in accounting. And of course, your finance classes, this is a central issue in corporate finances and valuing assets in general, is understanding free cash flows. So again, core principle when we're trying to answer the question, is this company creating and capturing economic value? Core principle is cash rules.